The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is analyst James Carlisle. Hey, JC.
Good morning.
And also joining us back in Canada, arguably where he belongs, in the cold, out there, lonely, freezing. Graham, welcome.
Hi, Gaurav.
I'm really surprised you spent all this time here in Sydney, and at the end of it, you still went back. I
It
half
rained the whole
expected you.
time I was there. 6 weeks
Well,
of
when
rain.
the day we went for lunch, that was a nice old day. I thought that was pretty nice.
Yeah, that was one of the highlights.
Well, of course. And the weather had nothing to do with that.
You got any snow over there at the moment?
Oh yeah, there's lots of snow here. This is one of their best seasons ever, apparently.
For those who don't know, Graham is a part-time ski instructor.
Well, no, not anymore. I used to be
Oh.
a ski instructor.
A former ski instructor.
Yeah. Then I got
Well-
into the investment business.
Yeah, from one tumble to another, Graham.
Oh.
The markets have taken a bit of a dive. JC, I don't usually pay attention to why these things are happening, but I hear it's something about interest rates and inflation. Do you want to give us a quick rundown of why everything is falling so much?
Yeah, I think it's just that there's been talk from central banks and various statistical people, about inflation increasing.
Various
And-
statistical people.
Well, the Australian Bureau of Statistics, the people who report the statistics on inflation.
right, okay.
They've been
Okay,
saying
right.
that inflation's. It's just being, I think last year they were all saying it was just a sort of temporary thing, and now everyone's saying it's maybe not such a temporary thing. Inflation goes up, interest rates will have to go up, and so everyone's brought forward their expectations of interest rate rises, and the impact on the bond market has been that the long-dated bond yields have gone up, so bonds have fallen, and if long-dated bonds go up, then the returns by which you measure shares, or which some at least. I mean, the discount rate when you value stocks has gone up, at making those cash flows slightly less valuable, and particularly long dated cash flows. So when you've got interest rates very low, then very distant cash flows are worth relatively more because they get discounted by less. The effect of the discount rate is less. So those growth stocks have really been hit hard, and that's really, I suppose, what we've seen.
I don't feel as though the index adequately reflects what's been happening in some individual names. I mean, I've seen companies fall 50, 70%, and the index has it fallen 10 at all?
Well,
Maybe nothing
I
more
mean,
than 10?
it's disproportionately banks, isn't it? And I suppose a few resource
And miners
stocks.
have done quite well.
So things
Yeah.
with big yields, which aren't growing so much,
Hmm.
so they aren't so heavily affected, their valuations. It's really, like, as I say, the big growth stocks, and particularly, stocks that aren't making profits at the moment, but people are hoping they might make profits in 5-10 years and then grow very rapidly. The value of all those future profits is reduced. That's the theory anyway. I mean, look, we obviously try to stick as much as we can to the individual stocks. I mean, my sort of discount rate that I use in my head sort of varies between maybe 8, 10, 12% around. It doesn't move as much as bond yields can move from 2% to 4%, which is kind of a doubling, isn't it? But I think most of us have all this a little bit muted.
Graham, it doesn't seem crazy to me, really. I mean, we've been sitting around the office, even on the podcast occasionally, talking about some of the crazy, risky behavior that we've been seeing. Crypto is probably the front of mind of crazy behavior, but there's been a lot of stocks, meme stocks, narrative stock, theme stocks. They've just sported massive valuations on nothing more than a story. These are all classic telltale signs of a top. Are you worried or surprised by what's happening?
Well, I guess I'm surprised by it because it all seems so irrational. But I guess
Irrational on the way up and on the way down.
It's maybe predictable as well. But I mean, it's just fascinating to look. It does feel very different to the last kind of 10 years or so, where there's one thing to be in a bull market, everyone's kind of mildly positive, things are going up, everyone's doing well. But now it seems that people are literally just acting crazy. Like some of the stocks that are moving around, things like, uh, I mean, people buying cryptocurrencies without even knowing what they are, and just there's all of those meme stocks, like you said. It does just feel different.
Feels a bit like people have got money to burn, and that's the
Yeah.
classic sort of sign. That
Yeah,
Yeah.
was 2007. That was 1999.
Yeah.
It
yeah,
feels as though people have got that money to burn, and I feel as though they're probably burning it. I mean,
yeah,
there's a lot. We were a bit. We've stayed away from some of the crazy high valuations, I think, and so there we go. We've had a few of our own mistakes, but that happens.
Mm.
But I think you see some of the high valuations, and they're predicated on these low interest rates staying low forever. And we were always a little bit skeptical of that, and so we didn't really allow the discount rates in our models to, our mental models. I'm not necessarily, spreadsheet models. We didn't allow those discount rates to fall quite as much as perhaps some did, and so our sort of valuations of things didn't go up as much as others. So I suppose we missed out on some of the upside on a few things, and but hopefully that means we're in a better position to avoid the downside.
It can have some real consequences as well. So a lot of these companies were reliant on market funding or debt funding to get them through their operations and not generating free cash flow. So if your share price suddenly halves or is down by 60 or 70%, it makes access to market finance harder. And of course, if interest rates are rising, it makes bank access to bank finance harder. So there are good reasons why a lot of those stocks should fall a long way. I
And of
guess
course, we got inflation as well. So
well,
the root
yes,
cause of the interest rate. So a
that's
lot of
right.
stocks, and that's what we're already seeing this reporting season, is a lot of stocks.
Mm,
James Hardy and REA of mine have talked
mm.
about rising costs, and
Oh, pretty much
so
every
it's,
stock I cover has
everyone's talking
spoken
about
about it.
rising
Yeah.
costs, and so that crimps margins. And then, as you say, you've got the financing side, the debt side. So the debt costs more, and the cost of equity capital is higher as well, and that's obviously tied up with what brings the ratings on stocks down a bit.
No one's actually reported this, but I also suspect once your equity falls by 50% and you're a young tech stock or you're a SaaS business and you're trying to attract staff and engineers to your business, you're not paying them cash, you're paying them in stock. And if your stock's not rising, it becomes quite hard to hang on to staff, let alone attract more staff. So it does have real. I don't think this is just an irrational response from the market, doing the up and downs of emotion. I think there are real impacts of this on real businesses.
And
So it
it's
makes
not
some
just
sense.
the shares and the options and all that sort of thing. It's also that people like working for companies that are
Yeah.
having success and doing well and seeing profits go up. It gives a sense of achievement, I suppose. And
Mm.
it's when your company's share price halves. I mean, I guess a lot of people don't care about it, but some do in smaller stocks, as you say.
Well, we've seen it in our business, right? Like when the InvestSMART share price goes up, there's a different mood in the office, I suppose, when
Well, I think
compared to.
particularly for us, it's seeing that we've achieved some quite good fund growth the last year or two,
Mm.
and so we're seeing that's the business is performing quite well. So the share price is a response to that, but also internally we see that the business has been performing pretty well.
Yeah, I do think I might be wrong here, gents, but it feels like it feels different to what it did in March 2020. And I remember we were in the office, and Graham, you were probably skiing or whatever in Canada, but we were in the office, and JC was almost jumping up and down. Yeah, I distinctly remember you being very excited, and just I think
About 2 weeks before everything
probably
bottomed, yeah, I was jumping up and down
probably
a little bit
probably a bit
before,
early,
yeah. But there we
but
go.
early, but still right. I think you were buying probably earlier than anyone else, but buying consistently. You were extremely optimistic about buying.
Yeah.
Is that the
Well,
case
I
now?
think I think the thing is that in March 2020, I absolutely did not anticipate the policy response to COVID, and so I was seeing cheap
Yeah,
stocks, and I did not expect that we were going to be, for example, closing our borders for most of 2 years.
yeah.
Things like that were not on my radar. So, look, I think I was probably wrong, except that it got the it got the right results. So,
Right for the wrong reasons.
yeah, I mean, look, when you knock 30-40% off the market, and
Mm.
you have to sit back and you say, well, is corporate Australia 30 to 40% less valuable? And I felt the answer was no. So, um, I mean, right now it is a little bit different because I think that the value of everything has got a bit pumped up ahead of itself in some
Mm.
areas. Look, we try to, as I say, we look at individual stocks, so we're the sort of looking at everything in an overall sort of fashion isn't our way, but it does feel as though there are some things which are pretty expensive.
Graham, are you as excited now as you were in March 2020? Were you even excited in
Well,
March
so
2020? I actually don't know. I didn't speak to you that much back then.
yeah, no,
You
I
were all the
was.
way over in Canada.
Yeah, it was one of those cases where I kind of was proud of myself in hindsight,
Mm.
because I do feel more comfortable when I can sense the fear around me in an investing
Mm.
context. Maybe not if I'm up against a tiger, but I can. Yeah, in March 2020, I could see people were scared, and that made me feel more confident that buying different stocks or things that looked cheap
Mm.
was probably going to be okay.
Mm.
That I know people will overreact in times of fear, and so it just gave me a better sense of the market was probably overreacting. It's these times that make me nervous, and I kind of sit around not really knowing what to do and being overly conservative, perhaps. Just because when there isn't a lot of that fear around, it's just harder to know, are you really getting a bargain if you can't tell why the people are behaving irrationally and selling
Mm.
it? Um, I think there's just more, it just becomes more important to get the fundamentals of the business right instead of just having a general overreaction present in the market that makes everything probably a little undervalued.
Yeah, there's definitely. I think you're right. I don't sense that same fear yet. It's starting. I think it's starting, but I don't
Yeah,
think
I
we're
feel
we're
people are
quite there
asking the
yet.
question, should we be
Yes.
scared? And that's
Yeah.
kind of
Yeah.
Yeah,
the first hit.
the fear breeds fear, doesn't it? So once things have
Mm.
Yeah,
fallen 10 or 20%, that's when everyone thinks, "Holy moly!"
yeah.
Um, is it going to fall another whatever? And can I afford it to? And should I move to cash? And um, yeah, so I think we haven't possibly reached that point, and maybe we won't. I mean, maybe the inflation, there is an argument that the inflation is due to sort of short-term supply
Yeah.
chain factors.
Mm.
Everyone's, I mean, the labour market in Australia is obviously going to be a bit tight because people haven't been able to come in from overseas.
Mm.
So there are skilled jobs which are in shortage. So there are arguments, and there's the whole supply chain disruption and everything. Everyone's having to pay up to get whatever they want. So there are arguments that the inflation is a temporary thing. It just looks a little bit less temporary than it did a few months ago, and that's what everyone's trying to grapple with. We'll obviously just keep looking at the individual stocks and trying to find a margin of safety, and that's what we do.
But there are still pockets of craziness. Tesla is still $1 trillion business. I would say in lithium, in anything to do with green tech, and probably maybe in microchips. There's a lot of irrationality around those stocks in that area.
I read
I
an
think I.
interesting thing this morning that could also be
Mm.
a top sign, which was uh, the number of Google searches for how to become a real estate agent have doubled. Uh, which yeah, I remember a similar story being out during uh, the US meltdown in just before the global financial crisis, that was one of the kind of top signals of the real estate market there, was that the number of people who had signed up to become real estate agents like tripled within 3 years or something like that. Um, yeah, so it makes you wonder.
Imagine how powerful if Google decided to ever go into share trading. I reckon they would make a really good trader just by analyzing the Google searches that they get access to. There
Yeah,
must be
there are some
so much
funds that
data there.
monitor Twitter and that seem to do okay.
Really?
By
Yeah.
kind of their whole game is watching social media and looking for trends there. I don't know about Google, but yeah, that would be an interesting one.
Algorithmically, presumably, with some
I
sort of.
guess,
I
yeah.
mean, they don't sit there
No, reading tweets.
literally watching it. Yeah, reading. Yeah,
Exactly.
no, it's all. Yeah, and Google would do it that way. Yeah, it's an interesting thought.
If
Well, they
if
have all
there's
the
a
information. Information is power, isn't it?
I put my hand up for the YouTube version of that. I think that'd be more fun than the Twitter version. None of us are on Twitter, are we?
No,
Uh,
No, not yet.
I
no.
do not twit.
I think it's
I
tweet.
watch Twitter, but I don't tweet. Yeah.
Oh, okay. All right. All right. So, JC, what should be the reaction here? Should we be jumping out and nibbling at it? Should we be backing the truck up, or is this a time for patience?
Well, it's a time. I think it's exactly what John wrote in his article last week. It's a time for making your watch lists and getting an
Hmm.
idea of where you'd like to buy stocks, what sort of prices you'd be prepared to pay. I don't think, as I say, I don't think the macro environment should change too. Possibly, your interest, your discount rate on things moves 1% or 2 here and there, but you're putting a big premium over the bond rates anyway. So I don't think it, makes that much difference. So you look at stocks and you try to decide what you want to buy, which is what we've done, what we're doing,
Hmm.
and you wait. You try to give yourself a big margin of safety. It's just all it's same old, same old. But when the market has big falls, there's obviously more activity, and you've got to. I suppose the trouble is the big question, I suppose, is whether you should try to raise cash ahead of these events.
Yeah.
I
Right.
tend not to because
Okay.
I mean, but I get greedier. I mean, um, I mean, I mean, my situation is different from some in that I have a mortgage, so I can flex that mortgage upwards. My cost of
Hmm.
capital is therefore higher, so I can be greedier in times like this, and less so when the prices are higher. I'm tending to sell. Whereas if your alternative is to sit with a pile of cash, then that's much more difficult. And I don't really not. That's the problem. That's the conundrum everyone faces, and that's why it's so difficult,
Hmm.
I suppose.
Hmm. Yeah. I think in my own portfolio, I don't think I've actually bought anything yet. Just trying to think. I don't think I think I bought some more coal when on some of those bad days, but that's about it. I haven't actually bought anything. In fact, JC, I've done what you were just talking about. I've been raising cash in preparation for worse to come, which is actually not like me at all. We don't,
Well,
I
that's a
thought you
bit,
might be
yeah, that's
horrified.
yeah.
Uh,
I'm a little bit hard. No, look, I mean that's fine because it's a question of
mm,
taking advantage of high valuations, isn't it? I mean, where you
yes, that's
see,
right.
and um, I bought a little bit of medical developments because
Mm,
that's
it
back
looks
down to
interesting. Yeah.
now back down to the price at which we first recommended it, from which it bounced very quickly.
Mm,
I paid more for my initial shares there. So I've topped that up. But my preference in times like this is to sell expensive and buy cheap.
yeah,
Which I mean everything falls a bit, doesn't it? So you sell um, you sell cheap to buy even cheaper, I suppose is
that's
the
right.
point.
That's right.
So you have a few stocks which you have your eye on, and you think, well, I'd sort of probably be close to selling that, even if it fell a little bit, to buy something else, which if that fell more, sort of thing. So you're always ranking opportunities, and so you just want to have a clear idea of how you rank all the opportunities in your portfolio. If anything is currently very close to being where you'd sell it, then that's perhaps what you've been doing, Gaurav. If something's close to a value that you're pretty
Mm,
comfortable selling, then you might think, well, now's the time to do that. And
yeah.
if things do get a bit cheaper, then I'll be prepared. So
Especially if the business isn't making any or much money. I think the mood has changed. I feel as though if you're holding significant positions in businesses that don't make money and are reliant on the market, you probably I wouldn't be comfortable holding big chunks in those companies for the moment. And they're the sort of things I was
well,
reducing.
it's the big sort of capital hogs. I mean, so NextDC would be an example of that, would it? So companies that are dependent on raising lots of capital, I suppose that's
Yeah,
But
I'm probably less concerned about that. They've got, the base business is so strong. They earn such good returns on the incremental capital, and they've got a lot of debt kind of locked in as well. I think they should be okay. It's more because they're backed by assets as well. There's
yeah,
billions of dollars of
and
assets
if they
sitting on
slow
that
down
balance sheet.
investing, then they would suddenly generate quite a lot of cash, wouldn't
That's
they?
right.
So it's
That's always
they can flex things,
discretion. Yeah.
internally. Yeah.
Because they generate operating cash flow, right? I guess it's those companies. One of them is Dubber that I recently sold. That's the sort of thing that doesn't generate a lot of cash flow. Probably holds a lot of cash, so won't need to go to the market. But yeah, not a lot of cash coming through the door, and that kind of worried me a little bit about Dubber, um, and other things on valuation grounds. I think the most expensive stock I own was arguably Australian Ethical, which was becoming, it went up so high, it just made me nervous and had to take some off the table. Graham, what about you? How have you been behaving in all this? Have you been buying or selling?
Well, no, I've been just holding.
Okay.
uh, but that's because I've got most of my portfolio at the moment in cash, waiting to buy a house. So I need
Oh
more of
yeah.
those real
See,
estate
you.
agents to sign up.
Oh, so
Yeah, no,
we're waiting
I
for an
haven't
equity
been
crash.
particularly. Yeah, I haven't been. If equities do drop or drop materially, then I'm not opposed to jumping back in. And there are some companies that I keep my eye on, kind of waiting for the right moment. But yeah, at the moment, I feel kind of neither here nor there. I'm just biding my time. We'll see whether that's a successful strategy down the track, I guess.
Hmm. All right. Well, do you have? We talked about watchlist a little bit, and Johnny published that article last week, putting together some of the stocks that we're looking at, along with prices at which we'd probably act on those stocks. We must have personal favorites, and this is the perfect time to voice those favorites. JC, I have an inkling about one of the stocks that you might mention. You did tell me earlier, but even without that knowledge, I would have guessed REA would be on that list for you. I think it's stock we've missed over the years.
Yeah,
Um,
yeah.
Probably
I
got
missed it at
wrong early on.
$12. I looked at it very closely.
I think even before that. I think when previous analysts
Oh yeah, no,
were
I'm not
looking at
talking
it,
about. I'm talking
yeah.
about before I was covering it. I missed it. I looked at it
Oh, did you?
for myself
12.
at
Oof.
around about. I think it was around about $12. Maybe I misremember, but um,
It's probably $5 or
and
$6.
so there's a little bit of pain there. But
Yes.
I think I told everyone to sell it at 35 or something
Oh.
in about 2013, 2014.
Mm.
I mean, this is I got stitched up by my own price guide. I mean, this is the thing. Sometimes it can be hard to move your price guides quickly enough when businesses are growing very,
Yeah.
very well. You get a bit behind the curve, and then it hits the sell price, and you sort of a bit. And the valuation always looked very, very.
Yeah, I
But this
know.
is the point with the businesses that are growing 20-30% a year. Then
Mm.
that they can support very high PEs, and look, it just keeps on doing that. So look, our valuation
Hold your
for
thoughts on
sorry, go on.
REA
Yeah, all
because
right.
I think that's one of the stocks near the top of my list that I would love to own during this period as well. So I thought they've reported results, and we'll go through those results in a little bit after we hear what your
Well,
other
it's
picks
not a
are.
lot to say, but I mean, they just
I have some questions before
keep.
I buy, actually. So
Oh, all
I did
right,
want to
go
pick
on.
your brain on it.
Yeah.
So I have some questions for you. We'll do that after we've heard the other stuff on our lists. What's your second stock? Do you have another one apart from REA that you're looking closely at?
I am looking. I'd be keen to upgrade Breville. I mean, Breville is the one
Yeah.
that I sort of pick
I
up
can't
before
believe
you.
you don't own Breville. Anyone who knows
Yeah.
who knows James would know that he'd probably own more Breville appliances than anyone else in the country.
Well,
And you don't own the stock. I'm quite
yeah,
surprised by that.
they're very good. They look nice and they serve
They're
their
very
purpose
pretty.
very well. Well, no, but they serve their purpose very well. This is, and I tried to flesh this out in a review I wrote on the stock last year, which is that it's
Mm,
sort of riding a wave. People think about technological waves in terms of companies like Zero or Altium or Ordinate or whatever
yeah,
it is.
yeah.
But Breville and manufacturing technology has come on in such a way over the last 20 years that you can make products now so much that weren't really cost effective maybe 20 years ago. The technology in the coffee machines that Breville is making now perhaps was available 20 years ago. I'm sure it would have been available 20 years ago. You just have had to pay 100,000 for it or whatever. The cost of making the thing would have been prohibitive. Those improvements in manufacturing technology and in what they can do, that it just puts it in a very good position to keep adding value to people. For the same price of a machine, you can get so much more. Breville just seems to take advantage of that very well. It's innovative. Like I say, the machines look pretty, which I think is important when they sit in your kitchen benchtop. Some of the other brands I just don't find as attractive. My wife doesn't find them as attractive either, which is always important. So it's a great stock, and it's always just been, just another one of those ones which has just been a bit too expensive for us, and it still is. I mean, I'd be interested in it below about $25,
Yeah, right.
which would be a forward P of about 28. I was just looking this morning.
Wow. Okay.
Which is still pretty pricey, but it's
Yeah.
growing. It's growing quickly, and I don't see that stopping.
I remember during one of our development sessions, I was given Breville for a quick look at, and I remember looking at the balance sheet for the first time, and I was really blown away because I thought Breville was a manufacturing business, but when I looked on the balance sheet, there was nothing on the balance sheet. There are no assets. This is clearly not a manufacturing business. It's
Yeah.
a brand and marketing business.
And design, design
And
marketing.
design, yes.
Yeah.
Good design and marketing. Thank you. That's probably better. Design and marketing business.
And the new chief executive has been very much shifting it in that direction and increasing spend on both those things. Yeah, particularly R&D, actually. Yeah.
And that probably explains the sensational returns on capital that these guys earn. It's because there's not much capital to deploy in this business. It's fantastic. I was really surprised how good this company actually is. And yes, that's a great pick. It escaped my mind, but that's certainly one near the top of my list as well.
But it's unfortunately, I mean, it got down below $26, I think, a few weeks ago. So it was really getting close, which is what brought it front of mind for me. But it's bounced up to 29 now, so it's a little bit further away. But fingers crossed.
I like it. Graham, look, I'm not sure what would be on your list actually, if I had to guess. You did tell me, but I won't use that as. I won't cheat. I wouldn't have guessed. What do you have?
It starts with a C. Can you guess now?
And ends with an L.
That's the one. CSL.
Yeah, this has been a bit of a white whale for you, hasn't it? You've covered this probably, I reckon, better than anyone in the market for a couple of years, and yet it has eluded you.
Yeah, well, when I think back of the different stocks I've upgraded across Intelligent Investor, I feel like I've hit all of the ones that I really like as companies, separating their kind of investment potential from the company itself. All of the big companies that I respect, like Sonic or I don't know, Ramsey or something, I've upgraded at some point. CSL is the one that's always looked overvalued, basically, until now. Now it's starting to look probably more attractive than at any point to me in the last kind of 8 or 9 years. It's down at $255 now, 20% or so from its high. And we've got an upgrade price at $230, which I think is about right. So we're not too far. It wouldn't take very much of a market fall from here for CSL to find its way onto our buy list.
Yeah. I put some money up for the SPP. As I never tire of telling you, boys, I've owned CSL since $30.
Yeah.
And it's going to be my second injection. I haven't bought it since then, mind you. But I put my hand in my pocket for the SPP. And I'm expecting, Graham, it's going to be in the 240s probably.
I don't know. We'll see.
Maybe a bit more, you reckon?
Yeah. Maybe a little bit more. Yeah, but it's also just one of those stocks that's benefited out of the pandemic in so many different ways that it has always been on a high price earnings ratio because a lot of its profits are predicted in the future. So I think that it's been affected by that whole increase in inflation and interest rate panic. But the business itself is just fundamentally sound, I think. So
And Graham,
it's just a matter of
they
price.
actually they expense what, about $1 billion of R&D a year, which
Yeah.
makes them the largest R&D person, the largest spender of R&D in Australia.
Yeah. Yeah.
And they expense pretty much all of it, which is that must make that PE look a lot less attractive than it probably would be otherwise.
Yeah, it's an interesting one. I mean, they do have to spend that R&D to stay competitive. Otherwise, the CSL 10 years from now isn't going to be the same one that it is today. So
Yep.
they are real expenses, but
Yep.
but they're also investments that when
Yes.
they're doing clinical trials for drugs or something or other, those expenses are building an asset that over time is going to earn back on average a decent return if they kind of average it out across their whole portfolio of prospective drugs.
Hmm.
So yeah, I think the price earnings ratio probably is a little bit overstated.
Hmm. JC, you've never owned this one. I haven't heard you talk about it much. Every 2 weeks or so, when I mention that I bought it at $30, you don't pipe up. You don't say anything.
CSL, well, before you came to Intelligent Investor, Greg asked me to write CSL up, I think in
Okay.
2004, if people really want to go
Oh,
and look
wow,
in
wow.
the back in the archives on the website, they can see the source of my embarrassment, because I think I told everyone to sell it at $30. No, I didn't. I
Oh.
think it was a take part profits or something.
Hmm.
But it was, it was very expensive back then. It was very expensive, and at that point, the immunoglobulin market
I remember it was
was
oversupplied.
very well. It
Yeah,
was oversupply. It was very
yeah,
cyclical. It was looked very unattractive. But they just completed the merger with Aventis Behring,
yeah.
and that proved to be the game changer. And I didn't spot it, but there you go. Sometimes you don't. Often you don't. You just have to spot a few. I didn't spot that one. So well done, Gaurav.
I take no
I've
credit.
been
I had
wrong
no
on
idea what I was
CSL.
doing.
Yeah.
I had no idea what I was doing. I don't think I could have explained to you what CSL did at the time. I remember I was a newbie at II, and CSL was on the buy list, and I thought I better buy something. Just kind of thought, no, this looks good. Buy this. Yep, and I've been bragging about it ever since. What's the second stock for you, Graham? Would it
It's
be
probably harder. CSL stands out, whereas the next couple are
okay?
they're on the way, but not quite. I mean, CSL is a super high quality company that I feel like we're
Yep,
about to get an opportunity to buy.
yep.
The next two, Gentrack and Hansen, are
Oh,
also high
okay.
quality companies, but they're not the
Hmm.
same league as CSL.
Hmm.
But yeah, they're not far. Gentrack, I think, is only just above the buy price, whereas Hansen has quite a bit more to go.
Hmm.
But yeah, they've been affected for all the same reasons as the other stocks, without anything significant being in their operations going wrong or anything like that.
Hmm.
Uh, so yeah, we might get an opportunity with those. They're both very reliable earners. They've got long dated, locked in contracts, very high free cash flow. Uh, and I mean, Gentrack at least has done a pretty good turnaround from a couple of years ago where it was getting into all
Yep.
sorts of trouble and difficulty. So
Hmm.
that's been a nice story.
Nice one. Yeah, I think we've done pretty well out of Gentrack since you upgraded. So that was brave and good work. One of the stocks I really want to buy is Domino's Pizza, and I remember I've owned this since we upgraded at under $40. But I want to own more. The more I look at this company, the more I'm impressed with it, and the more I think it suits the style of investment that I am looking for. I genuinely think this has maybe the best management on the ASX. I've heard this said of Don Mage. A few people I really respect have said to me that this is a great CEO. Uh, and it took me a long time to come around and see the quality of this business. I used to pay it out and not talk so highly of it. But after looking under the hood and getting to know it over the last 2 years or so, it's a company I admire tremendously. I think it's fantastic. Um, and the story that got me over the line really was the opening in Japan. And we've probably discussed this before, but if you're new to the pod, then then you know that Domino's earns a lot of money from Japan. But it wasn't always the case. When they first entered Japan, they were a laughing stock, and the share price fell, and people would sort of ask, "What are you doing in Japan?" Japanese people do not eat pizza, and in the early stage of that Japanese expansion, they were burning cash and not doing anything. And then a couple of the management team actually moved over to Japan, and they spent months living there and just tweaking all the operations and the menu items. And you can see the the results of that dedication. Japan is now the highest earning region in the Domino's empire, and I think there is so much room to grow over in Europe. And when you have a franchise operator that does so well, other opportunities pop up. I thought there might be a shot of buying the UK franchise as well. Those guys have turned around a little bit, so maybe not. But this is such a fantastic business. It just shows that there are lots of options for really high performing franchisors, the guys who own the franchise, like Domino's.
Franchisees. Yeah.
Is that what it is? Yeah. So I'm itching to buy that thing again, and I'm
Well, Domino's
hoping.
itself is the Australian one is
yeah, right.
itself a franchisee of the head franchisor, which is the US Domino's.
And that US business has been. I think I was reading that since its IPO, it's actually returned a higher annualized return than Google has, which was surprising. But I think the more you think about it, it does kind of make sense because it's a fantastic business. But they've been warning about higher costs, and I think the lower share price in Domino's Australia, I think that's kind of factoring in some margin compression, JC. So it'd be interesting.
Yeah, that's
to
right.
see
And they also, Japan had a poor period, so we're waiting to hear a bit more information about Japan.
Understandable why Japan did, I think.
Yeah, that's right. Look, everything's a bit up and down at the moment, but I think fundamentally the points you make about it being a great opportunity, makes great returns, and unlike some, I mean, it has a long potential, runway in Europe and Japan. And so, it's one I like as well, but we want it a bit cheaper, greedy as we are. We're looking at about $90, I think, is the buy price for that. And
it's interesting because
we're not far off. Yeah,
that's still 2.5 times what I originally paid for it.
Yeah,
and I'd still be happy to buy at that price. I think that's one of the big developments.
Well, it's grown a lot. I mean, since
it's grown a lot. That's true.
Yeah, I mean, it has. Yeah.
I would say 5 years ago, though, I know you used to do this all the time, JC. Used to buy up, but I always struggled doing that, and that's one of the things I've changed over the last few years, and it's been a great change. Paying more
CSL at 230 instead of 30.
$30. Well, that's the thing. I think this is a pivotal moment for me. I'm actually buying. Yeah, I'm going to buy CSL at 200 something rather than I've never contemplated buying more because I thought I bought at 30.
I still find all that very difficult.
You find it hard?
Anchoring.
Right.
Yeah, I mean, once you've paid a price or decided on a price you want to pay for a stock, it is hard to shift it. And this is
especially the fast growing ones.
The fast
growing ones. Earlier, that's what makes a price
when their value is growing faster than you can keep up with.
Yeah, that's right. But it's an important thing to be able to do to shift your perception of the value along with the business.
Now, the other one, I'm actually writing up the results now, and by the time you're listening to this, they'll probably be on the website. But if they're not, they're coming soon. Is Mineral Resources, which I know has been a contentious stock inside the II office, and it's probably one that I bring up too much because I own it and you don't, and and it's done very well. But we've got some price guides on MinRes now, and I think we're going to get a shot in this cycle of buying some. I think we want to remain disciplined. We shouldn't forget that this is a cyclical business. They're outlaying a lot of money for expansion, but there is a wonderful business here, and it's not obvious that it's a wonderful business until you start looking a little bit deeper. So we've kind of talked about this. I don't want to lay out the whole case, but there's three parts of it. There's a mining services business, which I think is fantastic, and I think I've got twice the valuation of anyone else in the market on it, but I stand by that, and I think it's completely misunderstood by the market. an iron ore business which is loss making at the moment, but they're investing money to turn that into a really high quality iron ore business. And I've seen the detailed plans they have down to the road hauling trucks, bespoke crushing plants, and agreements for port allocation. I think it's really smart, and I think they can get there. There's a lot of skepticism in the market about that. And finally, the lithium business, which I must say, I'm probably it's a fantastic geological asset. I'm a bit unsure about the whole lithium space, but I view that more as an option. And I think if you can get that at the right price, this is a great combination of assets. I think the CEO is a master. I think this is a great example of hustle. Every time I hear him speak, he's got more ideas about how to squeeze more money from here or there, or take more opportunities, make more deals. Not everyone likes that, but I think he's a great operator, founder, and owns equity in the business. So I'm really looking forward to upgrading that at some stage. And the other one, if I may, is REA, JC. But I had some questions for REA before I wanted, I got a chance to
I hope
buy
I
it.
can answer them.
I think what's kept me out of REA for such a long time is just the growth. I mean, this is already the dominant platform by a mile. I think they say that there's sort of 6 or 7, maybe more eyeballs than Domain. They are so far ahead. I wonder how much more monetization they can actually get. Can they keep raising prices? Because when you look at the profit increase, most of the profit increases come over the last few years has come from price increases and more premiumization of the inventory.
Well, I think
And
that's the key. Yeah,
can that keep going?
yeah,
I'm not sure whether how far that how long that has to run. Are we, can profits double again from here?
yeah. I mean, I think you've got to look at what they've been doing. So that I mean, it is the premiumization and it is the price rises, but they're giving so much more for those prices and the premium offerings. So you look at I don't know 15 years ago, and you just sort of saw a listing. You're lucky if you got a picture.
Yes, I remember
And
those days.
now you
When
got
my
you
parents were looking for a house, I distinctly remember being dragged around. You're lucky if you got a picture, and you turn
yeah,
up to the property,
yeah,
and sometimes my parents wouldn't even go inside. They're like, "Oh, this is pretty shit," and they'd walk
yeah.
out again. You
But
just didn't know.
what you can see now gives you a sense of the entire property. It really, you have lots of pictures, you have walkthroughs, you have all sorts of things. But they're doing more as well. In terms of engaging their audience. So, in terms of, I mean, I get emails from them for telling me what they think my house is worth and things like that, and
Mm,
telling me similar sales in the local area. Not that I mean I do this because I follow the stock, but you can also sign up if you're interested. Um, uh, you know. In particular properties, and they'll send you emails, and those are much more added value than they were. So you're getting a lot more. They're working hard behind the scenes in adding value.
mm,
They're doing that for agents as well. In the offering that they provide to the agents, um, and the different sort of premiumization, depth products they call them.
depth products. That's right. Yeah.
And the thing is that with a house, when you buy or sell a house, the agent's commission is in the tens of thousands, whereas REA is getting something in the thousands. And so
Mm,
there's
mhm.
there's
And we know
there's a
who's
lot.
doing most of the selling work there, don't we?
Well, the value. I mean, look, I think you always need agents, but agents are getting a lot more from REA, and REA is providing a. They're also. I mean, there's opportunities obviously for them to extend into financial services as well and do a bit more in terms of providing you with a mortgage, and
Mm,
so they bought Mortgage Choice, and um, there, I think there's still a huge opportunity to, buying and selling houses is something that's worth a lot of money, and I think that they're in a very good position to keep taking more of that, and they're investing hard to achieve that. And yeah, I mean, look, we've been skeptical of it in the past because these growth rates, it's hard to believe that they'll
yeah.
continue, but they seem to,
Yeah.
and I think that there's a long way for that to run. Plus the
Yeah.
property market. I mean, look, long term, you expect it to grow, don't you? So, what it does in the next few years, who knows? But so they've got a tailwind from that as well. Um,
Are you worried that one of the things that concerns me is that they rely on payments from real estate agents, but at the same time they're almost competing with real estate agents as well. There's ideally you would like FDV, for example, which is also a recommendation. Zameen, which is a stable in FDV, those guys act as the agent in some instances, and they kind of knock the real estate agent out of the picture, and they absorb the real estate agent's fees, and they do transactions completely online for new dwellings, for developer dwellings. Now, is that I don't know if that's possible for REA, just because of the reliance on agents. If they started doing that, there'd be a lot of pushback from agents. I wonder if that limits the upside for REA at all.
well,
That's the logical conclusion of where this service should go,
yeah,
but I
but
don't
I
know if
think
it
that
can go there.
the key. I don't know. I don't know that you want to cut the agents out of. I mean, you still need people to open the front door, and you still need people to advise sellers on how to
I tell you
present
what,
a property.
JC,
What's
paying
that?
30, 40,
Well,
$50,000
no, it's all
for
right.
the
That was. I mean, look,
yeah.
sorry, agents do more than that. I've got, they advise a
Mm,
property seller on how to present a property and how to, market it, and there's something for agents to do. But the what REA does is make their lives a lot easier. And that's what that's their selling point. They're trying to
mm,
trying to increase the value they offer to agents. Um, and the good agents can make use of that and still sell. They make use of that and sell more properties and get more commission. So
mm,
I think look, as you say, their opportunities to work with agents and improve the value on offer, and they've consistently done that, and I think there's plenty of room for them to keep going.
And what about in terms of valuation? I always struggle with this as well. I mean, I reckon this is the best quality business on the ASX. So I'm probably less concerned with PEs, and everything drops down as cash. So there's a good reason why they should trade at a very high multiple. But what kind of range or valuation are you thinking about?
Well, so the current on historical earnings, well, actually, 22 earnings, I think they're on about 45 times earnings at the moment.
Hmm.
But that drops down for 23 to about
Wow.
38 times. So the point, this is the difficulty
Oh,
you
so
always
in
face.
23 it drops down to 38. Sorry, I thought you said it drops to 23 times. I thought, whoa,
No,
that's
no, no, 38. But if you're
okay, right.
dropping, if you're dropping 5 or 6 percentage points, sorry, rating, PE points
Yeah,
every
yeah, yeah.
year, you quickly get
Hmm.
down. Um, Look, this is what I was saying earlier. We are always a little bit reluctant to pay these high PEs, and that's why we've sort of, I suppose, why we've missed it the whole way up, really.
Hmm.
But you know, if it got to below 120, that's our buy price. That would be a 23 forward price earnings ratio of around 33. With every chance for it to come down well into the 20s over the next few years, and that
Hmm.
I think would be very attractive.
Hmm.
Um, so fingers crossed. There's a potential for the environment to get a little bit dicey towards the end of this year. I mean, we've got all the macro issues, of course, but then we've also got in terms of listings, we've got a federal election in May, Easter and Anzac Day being close together. REA was saying they thought that would possibly put a dent in listings in April. Everyone going away on holiday.
Okay.
Um, so possible RBA action to slow the property market, or APRA. Um, so yeah, there's a possibility for that price to fall a bit more, and
Hmm.
fingers crossed.
Graham, thoughts on REA? Is it on your watch list? Is it on your wish list?
Well, yeah, there's no doubt it's a good company. I don't know it as well as you two probably, but I know enough about it that I'd buy it at the right price.
Nice. Okay. All right. That's it from me, JC. I remain convinced. I'm looking forward to your upgrade. Hopefully, we get it this time, and I'll be one of the first jumping in there. And maybe 10 years from now, we can be boasting about how we bought REA at this wonderful price. And
Well, we're
made
not
this
there yet,
fantastic 10
but
bagger.
yeah, hopefully, yeah.
And get to participate in their share purchase plan at 1,000.
Yes, I would do that. I would pledge that right now. Yes, done. Right, back to reporting season. We've got results to get through, so I better let you gents going, and I've got some to get through myself. So, JC, thanks very much for your time today.
Great, good to chat.
Graham, welcome back home, and good to see you while you're here. Thanks for your time today.
Thanks, Gaurav. You too.
And for everyone else, thanks for listening.